Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have a bit of a longer show just because we missed last week, but we're back, and unfortunately or fortunately in terms of content, there's been a lot of data that's come out. Most recently, for those that maybe might have missed it, you had the Fed meeting yesterday, you had the GDP numbers today for Q2. And we really want to go through what all of this means. So in the first segment, we're going to look at the IMF and their global estimates. And as you can tell, they've lowered them once again. And just based on what the U.S. just printed, I would assume that they're going to have to go lower again, as well as with what we expect to see in China. And this is what we've been saying, is that they're just not, or maybe they're scared to do it, or they want more data before they officially move things lower, but it's still not enough. There's still more downside to a lot of this data. Then we're going to provide an update on what's happening with Russia, Ukraine, and how is that impacting the grains market or the food market, really, just because we continue to see prices moving higher. And then in segment 2, we're going to talk about the U.S. GDP, the big miss, and then what does it mean for the second half of this year? Because and I will answer the question of, is this a recession or not? And technically, I know it's frustrating, but it's not. Even though it's usually accepted in a lot of places of around the world that the GDP coming in negative 2 quarters in a row is what you need to have a recession, but there is some wiggle room within that, and we'll go through where that wiggle room is and why there might be some hesitancy. But regardless, we're in a recession. Our view is that we were going to actually get a little bit of growth in Q2, and that Q3 was going to be the kickoff of the recession. And based on everything that we've seen, we still believe that that is the case. Then we're going to talk about housing faltering further, and then some key leading indicators from the Fed, the regional Fed data, and how it points to that bigger problem, which is that Q3 slowdown. Europe is just going from bad to worse. It's not, there's no improvement. Things are only deteriorating faster. Back to the point on why the IMF needs to reduce their estimates further. And then the Chinese economic data is getting worse again, and they're now talking about actually lowering their GDP target. And so again, all of these things culminating into why there is this an incorrect view of what a recession is in the market, or a global recession, and why the IMF and not to just pick on the IMF, because they do great work and they put out some really important stuff, and they share the data, so you can point to, oh well, I disagree here, here, and here, but everybody, or at least the banks, are not willing to call a recession yet in the US or globally, and we're sitting here saying, well, that's where we disagree, and that there is already something afoot, and it's only going to get worse. So here's the key pieces from the IMF blog. If you're not subscribed to it, I would recommend it. It's free. They put out great data, obviously beautiful charts, and we all know, based on those that watch these shows, how much I enjoy charts. So these are some key pieces that we want to look at. So they have growth slowing. Growth is forecasted to slow to 3.2% this year and 2.9% next year. Downgrades of 0.4 and 0.7 percentage points. And now it's important to look at where they were in 2022. In April of 2022, you can see that everything has shifted to the left, which is obviously a slowdown. When you look at the advanced and the world side, the advanced economies is where we see some of the biggest disconnect, especially because we believe that the U.S. is already in a recession, Europe is already in a recession, and that these numbers need to go much lower. And there's going to be a lot of pressure that's going to be driven based on inflation, and that doesn't even begin to touch what's happening in the emerging markets. So we're going to talk a little bit later about Panama, about Iraq, and then obviously about what's happening in Russia, Ukraine. But one of the things, and I was asked to give some quotes in an S&P article, was just about, what's happening with commodities? Why aren't we seeing prices come down, even though there's clear demand destruction? And this isn't just oil or gasoline. This is a broad view, and we'll have that data on that in segments 2 through 5 on just where we've seen this demand destruction. The problem is supply. And as we've talked about, and those that have been loyal followers since 2020, we've been calling for a food shortage. We've been calling for, look, and food shortages don't happen overnight all at once. They build up over time. And that's why we continue to see this stagflationary component, which is going to be more detrimental, more impactful when we look at just this inherent slowdown and the pressure that's going to come through. So growth revisions in general, China, I think they're going to have to take further down. Same with the euro area in the U.S. And this is obviously after the U.S. This came out before the U.S. reported GDP numbers. So if you take U.S. Q2 GDP, which came in at negative 0.9, and then you look at, well, what are the leading indicators saying? PMI has now gone fully negative. It's below 50 in contraction. As we've been talking about, those leading indicators of new export orders, new orders are going negative and have gone negative for several months now in both Europe and the US. And we do believe that that's going to pull down the emerging market piece. And then obviously here on the global inflation side, you can see how they continue to take that move higher. But one of the things that I do agree with when you look at the IMF piece is how they have that inflation a bit longer. Because if you look at some of these banks, and the Fed, you have this massive spike and then this huge drop down. And theirs is a bit more gradual, and I think that's the right way to think of it. You know, I don't think we've hit peak inflation yet. I think we will have some growth. Obviously, gasoline and diesel in the U.S. will be a benefit in July, so we will get some of this pause. So we're seeing some of that leading indicators on the PPI side getting a bit better, and prices paid, prices received getting a bit better. But that's more of the stagflation, which they're pricing in at this point. I just think that the stagflation or that top lasts longer, and then you get something a bit more gradual. I also agree with their view that it's going to settle much higher than where it started, especially on the emerging market side. I disagree on the advanced economy side where they have it coming lower. I think that I would say that obviously the advanced economies will be lower than emerging and developed economies. I just think that they're going to look similar in the sense of we're not going to get this big drop through. Instead, we're going to be stuck at this much higher inflationary standpoint based on where wages are, where input costs remain. And that's why we keep talking about these leading indicators and how they're flattening out and not getting this big drop, which gives us the confidence to say that, which is where we think there needs to be an adjustment. And then as this inflation increases, as the economy slows, this is where debt vulnerabilities come in. Because if you can't maintain your economy, exports are slowing, the ability for your local consumer to consume, that becomes and creates more vulnerabilities, especially with the dollar still sitting at over 106. It's come back a bit, but it's still over 100. There's still a lot of pressure in the market, and this is going to reverberate the most in emerging market economies where diesel, gasoline, oil is all based on the petrodollar. So how many dollars do you have available? And if you're using some of these dollars that you have or foreign currencies or in their foreign reserves to stimulate and try to maintain the semblance of low inflation, these are the assets backing it. This is we need, or these countries need these dollars or these euros in order to raise rates and give people some confidence. As that dwindles, then the risk of debt defaults goes up. Then the risk of emerging market problems, especially as the rates continue to grind higher. So you have the dollar side, then you have rates, where obviously the Fed took their rates up by 75 basis points, and that puts more pressure on the emerging markets because they typically price off of our 10-year. And as you see that move up, now there's two different sides to how U.S. bonds move. One is obviously you have the inflation expectation, which is where is inflation going to go. Then you have what is the the Fed funds rate, and then you have what is economic expansion going to look like, and that is where you get this push and pull in terms of where it is. But we continue to see this volatility, especially as liquidity drops. You see money M2 coming down or money supply coming down. That's where we see more, and we continue to see We don't have the slide in here, but again, bond volatility remains very elevated, which makes it very difficult and increases the spread for this international emerging market debt, creating these problems, which is why we've seen financial conditions continue to deteriorate in China, and then even outside of China. Like, this is a deterioration across the board. We think that China's flatlining a bit in terms of how financial conditions are going, and we'll talk about some of the new programs that the Chinese government has rolled out, but EMs and emerging markets in general are going to continue to get worse. So global growth optimism is at an all-time low. I don't think that's a surprise to anyone, given the data that we've seen, the problems that we're seeing. It's just, how low is it going to go? And I would say that it actually is going to continue to go lower, because you still get some blips of confidence. And I think that is going to continue to move to a global all-time low, especially on the overweight equities, because there are some people that still want to purchase where we are. So the global recession is coming. When you look at new export orders are nosediving in Germany. And again, Germany, and this is why we talk so much about export orders, new orders. You have China, which bounced and is actually coming back down. US, which is nosedived, Eurozone. But Germany is leading the way. And Germany, being a key export nation, is going to continue to pull the Eurozone down. The U.S. is moving lower as well, which actually is a net positive for GDP, because if you have our exports, which are coming down, but imports are going down further, then it actually makes our trade balance look a bit better, which is a net positive, or something that to look at. And the reason why we talk so much about Germany. Germany is one of the world's leading exporters. So this is about faltering global demand and the coming global recession. Only outlier is China, but that is a temporary post-COVID bounce, which we talked about, and we've already seen it reverse as we come out of July and into August. And we actually saw things slowing mid-July, which we talked about with South Korean data and Chinese data 2 weeks ago. Three economies account for more than half of the global economy, which is why we spend so much time talking about them. U.S., China, Euro area are the key pieces. And again, they're all showing the warning signs and the problems, which is why we believe that IMF estimates have to come down, and local banks and the U.S. banks continue to see something that I guess they want to believe, but isn't based in data or fact. But you can only lead a horse to water. So when we start looking at inventories, surveys of stocks relative to desired levels, Eurozone, UK, US, you're starting to get that bounce. And again, as you get inventories rising, that's actually a positive for GDP, but we did get a small decline in the US on Q2 inventories. And it's just that's this back and forth. Because as much as you want to rush out and refill your inventories, you also don't want to lock in the higher prices. So as prices come down, you should see some inventories coming up a bit more. And I think that's going to be a bigger piece as we go forward. So more emerging nation bonds are, again, entering distressed categories. Option-adjusted spreads to U.S. Treasury curve. And this is what we've been talking about on the curve and the spread, where as you get inventories slowing down, you're getting to more of a comfortable place, still upside with a lot of that coming down from the emerging markets, you're going to get some of this back and forth. And again, this is why we see, and we continue to see, and you can see here, obviously El Salvador, Pakistan, Ethiopia, Tunisia, Ghana, Suriname, places that continue to have inflation problems, IMF issues in terms of where are they going to get loans. El Salvador went in headfirst into Bitcoin and bought near the top, so they're going to struggle at this juncture. And then, as we know, Pakistan continues to have not only inflationary problems, but geopolitical and really political uncertainty. And then there was a back and forth in terms of, how is Saudi Arabia going to give money? Because the IMF has been withholding it, given the issues that we've seen or concerns around austerity versus spending, and then obviously the political backdrop, which creates that uncertainty going through, and that the Saudi had said that they would step in, but that still remains to be seen. Global Consumer Confidence Index at an all-time low. I don't think that's surprising given where the consumer sees their wages, their costs, and that's going to continue to be a problem. And the reason why is, what is the average decomposition of household assets? And this is looking at 29 OECD countries, and I think it's a really important chart because you get an idea of how much secondary owner-occupied housing and secondary real estate and how important it is. And just think about '08, and this is, it's come down, but when you look at the US, we're at about 28% of assets sitting in real estate. But when you go through the rest of the countries, you can see a lot of countries are closer to 75% when you look at all in real estate, with South, and they're not on here, but South Korea and China being along the lines of closer to 65 to 75%. So again, South Korea and China are on the very high end as well, but this is why real estate matters so much for so many different things. And as you see real estate prices coming down after the let's call it 10, 15 years of just unfettered rising, that is now going to pivot how people view the world, how people spend, and that is reflected in what people, or how consumers are viewing the world. And the little ticking time bomb that is a really long time bomb that really going to create bigger issues is fertility. And as we've said before, to have flat population growth, it's about 2.1 children per female. And here you can see that that's continued to come down. And one of the big pieces that we've seen in general is that it has fallen exponentially in a lot of areas, including China and other parts of Asia. And that's going to become a much longer term issue, especially when you look at housing, when you look at economic productivity. And these are some little things that are important. Now, when you think about the immigration side, the U.S., given takeaway politics, the U.S. has a pretty good immigration policy where we bring in a lot of immigrants. They settle in the U.S., where there are a lot of other places throughout, China being one of them, other parts of Asia, that don't really allow immigration to a meaningful level. And that's going to accelerate that down move, because typically people coming into the U.S. on the immigrant side are much younger, typically looking for a better life, want to come in, have children, raise a family. So that helps bridge some of that gap for the U.S., but you don't get that in Asia. And that's going to be a bigger problem, which is why we've seen such an aggressive drop, especially in China, where they're just teetering on the edge of shrinking. And we do think that they will shrink and go below that replacement fertility rate that we've already identified. Now, the view is that if you do a more front-loaded hiking, it is associated with a softer landing. Now, the problem is there was a lot of delay when you look at when the Fed started to raise rates, when Europe started to raise rates. So that's especially Europe, which just started for the most part, and they're still barely above zero, if not at zero at this point. And that's going to create, again, that harder landing that we've talked about. Now, the question is going to be, did the Fed start at the right time? Did they start too late? In my opinion, they started too late. So I think they're now trying to rush, but they're not willing to go too fast to avoid that hard landing, which is why I do think things get worse, not only just in the U.S., but in Europe, which is going to draw down pretty much the whole global economy. But when you look at earnings revisions, the U.S. has come down faster. So Japan and Europe still haven't had a lot of stuff priced in, still going to see that downward movement. And I think that's going to be a bit of a shock when you start looking at earnings and how that gets readjusted. Now, when we turn to prices for fertilizers, they increased rapidly in 2022, but we don't see it coming down too much. Now, one of the things that we've been talking about, for those that have been following us, we've been bullish on fertilizer, but we've been saying that it's going to get to a point and then just hold. Obviously, it ran right through that, but now it's coming back, and now you're seeing it get very sticky at these levels. And China is no different, and that's going to increase the cost for the farmer as we go into next year, which again is going to keep prices elevated for food, for farm goods, and is going to become a much bigger problem. Now, just on that point, Ghana's cocoa crop set for a 20-year low after drought. There's been damage. Again, there's a lot of issues when you look at the global market, and is also going to add to the pressure of this debt, of the ability to finance it, because again, Ghana is an exporter of this. And if they're exporting this, they're taking in dollars, and you're not going to see that type of flow. So when we start looking at conditions in the U.S., you can see that U.S. corn conditions versus last year are slightly worse. Same with soy. It's very lumpy when you look at what is happening in some of these areas, especially when you start going through Indiana, Kentucky, North Carolina, Tennessee. And then when you look at soy, when you look at Louisiana, some of these other areas, then the question is, how can the areas that have done well, like on the corn side, North Dakota, South Dakota, Minnesota, are they going to be able to offset weakness in some other areas? And the same can be said for soy. I think in general, you're going to see a much weaker yield, and and again, this is just based on historics, because here's, I think, a key piece. Now, I was going back and forth with someone on Twitter who has been saying that since the 1930s, you've had nothing but straight up increases in corn yield and yields in general, which is accurate. Like, there's no arguing that we've gone up, but then you have to think of how is the population grown in that time frame, from the end of World War II to today, and where is the world population going from this point? And I think Karen, who is that handle at the bottom at KANNBWX, she does a good job. And this is what my point was back to this individual. You can't look at just the trend. You want to look at the last 10 years. Where have yields gone over the last 10 years? And you can look and just see that we're not going up. We're getting stagnant. And even if at that chart on the right, you can see that it's starting to clump up, and you're not getting the next level up. But even though we do have a population problem forming, we still have population growth. So how is this being made up when you have a fish shortage, you have obviously a food shortage, and we're not getting bumper crops. If anything, we're getting below bumper crops, and it's going to put more strain. And this is before you factor in Russia, Ukraine, and how that's disrupted things, which we'll talk about in a minute. And again, these are the problems that we're seeing, which is going to drive inflation. It's going to create problems, especially on the emerging market side. And the areas that will get it the worst are going to be Africa and Central Asia, where they rely significantly on imports because they don't have enough to feed not only just themselves in country, but also within the region. So then when you look at emerging market central bank moves, they've tried to get ahead of this, knowing that there is an inflation problem coming, trying to get in front of it, while the advanced economies were very slow to react. Not so much South Korea, who I think was smart in terms of trying to get in front of it. But this is going to create, again, some of those problems on the economic front, which is why I think emerging market economic expectations are still too high, because this will weigh on activity. And this is one of the reasons why we continue to see global manufacturing PMI moving in the wrong direction. Flash July has already gone negative in most of the advanced economies. And typically, advanced economies go negative first, and then emerging markets go down. So now that you have manufacturing contracting in advanced economies, there's usually a 3 to 6 month lag. I would say 3 to 4 months is probably fair for how this filters down to emerging markets. And then you'll see that come down, which again is going to make some of this worse on the emerging market front. The spread on dollar-denominated debt, you get an idea of just how high it's gotten. Pakistan obviously leading the charge in terms of that spread, and just based on the issues on taxes, geopolitical uncertainty, we don't see that getting better. If anything, we see it actually getting worse. And then the emerging market spreads by sub-region, obviously getting worse in Latin America, but the biggest ones remain in Central Asia and Africa. Now, when we look at Russia, Ukraine, so there was this was taken at 3 p.m. yesterday. After this snapshot was taken, there was a pretty broad Russian offensive to take back a lot of this land that you can see on the chart on the right that the Ukrainians have been able to take to regain under counterattacks. So they've done it across the whole line. They try to have a coordinated move, because if you want to think of, again, not to pull back, but if you think about Battle of the Bulge, the idea was trying to break through some of these lines and then meet in the back and again, try to cut off, so take out the flanks, push the whole front to the line of engagement back, and then hopefully make headway and break through the line, so then you can circle around and then encapsulate some of these Ukrainian soldiers. The problem for Russia is that a lot of these Ukrainian lines are very well dug in, and the Ukrainians have been very tactful in what they've struck on the supply chain side. Again, hitting bridges, hitting rail, and other pieces. Now, this was to give some breathing room, because you can see that the Ukrainians have made some inroads, and this has been able, especially in Kherson Oblast, which has been a big problem for them. And I'm sure you saw some of those highlights from the Antonovsk bridge, where the Ukrainians were able to essentially make it inoperable. So on the Kharkiv side, that continues to be a big push. The Ukrainians continue to hold that. So when we talk about the offensive, it was really in the Oblast side, the Monetsk and the Donetsk side. So again, that's where we're seeing the biggest push. But we will get updates today on how effective they were. And here's where on the Kharkiv side, they continue to make those inroads. We don't see that changing. And if anything, you see the rotation down, where when you look at what they're looking at, they're the Russians are focusing more on Donetsk, which you can see they've continued to make headways, and they want to continue to do so along the bottom, along the Black Sea, to again create some of that buffer and move over. And the reason why is because one of the things we've been talking about is they've been wanting to take over Odessa and take out that Black Sea. So they pretty much have the Sea of Azov, but they really want to take that Black Sea side. Now, I know we've heard commentary that there's going to be an agreement. We're going to see grains flowing. But one of the things that we've been talking about is that it's very unlikely. So more than 90% of Ukraine's grain exports depart from Odessa and Mykolaiv ports on the Black Sea. But targets in Odessa were hit Saturday by Russian forces, and Mykolaiv mayor says that the port was hit on Tuesday. So even though if they come back and they say, oh yes, we've come to an agreement, this is where things are going to flow through. Well, 90% of grain exports come from these regions, and they've just been struck. So how much damage is there? That's going to become a much bigger issue. Now, shifting gears a bit and looking at the Middle East, protesters in Baghdad stormed its Iraqi's parliament inside the Green Zone. And the issue is, and now I'm going to talk about Shia, but it's important to understand that there is a Shia cleric, which is Sadir. Now, even though that Shia, they are not attached to Iran. Now, there's different, we can have a debate on if they are or not, but the person, which is Mohammed Soudani, which is the opposition leader. So Soudani is expected to win and potentially become the PM. Now, he is the nominee of the coordination framework bloc, which is a coalition led by Iranian-backed Shia parties. So the problem is, even though they're both under the Shia umbrella, there's variations between the two, So what were they saying? Iran get out, the anti-Islamic Republic protest, and that's, I think, the biggest component is they want Iran to get out of their daily lives, to get out of politics, which is what created this. So again, there's still a lot of geopolitical uncertainty in that region. In terms of where they are, the unrest amounted to a warning that there could be further protests if the government forms under Mr. Soudani, who is widely seen as a close associate of former Prime Minister al-Maliki. And now the thing is, Maliki was very well tied and known to be tied to Iran, and the whole goal was to get that out. Now, with some of these adjustments, this is going to create more issues, which is why we still see a lot of problems. So far, we don't see this spreading to some key areas, especially southern Iraq, that with the crude that comes out of Basra. But this is going to be an important one to watch. All the while, coming back to everything that we've seen, food prices have reached record highs, and this is global real food prices, not just the things that are flying around. Real food prices continue to hit those highs. And we've seen already issues in Panama, and that's on the back of, again, labor, that's on the back of food. A lot of these issues are going to continue to crop up. And then the industry and households account for more than 2/3 of gas usage. And this is from Germany. So when you look at what has happened so far, again, coming back now to what on the energy, keeping with the energy front, but moving to Ukraine, Russia has cut further gas flows into Europe, and Germany being the hardest hit. This gives you an idea of why industry, which is 37% of gas usage, is already expecting to get to have caps put on their natural gas consumption. And that's to ensure that there's enough for households, which is going to ration. That's what it is. So industries are expecting rationing, which is going to become, I think, a much bigger problem. And we don't see that getting better as we progress. Just to give you an idea of the energy imports and the dependence ratios in Europe and how important it is, and the gas pipelines that link from Norway. So Norway can provide some of it, but you're missing a huge amount, and there won't be enough to really make that happen. So again, there's a lot of problems, and we're going to cover this more on the FSC show and really talk about how is that going to impact U.S. LNG, U.S. flows, because there's not enough LNG in the world to make up for the loss of pipe gas, but we want to go deeper into that, which we will do tomorrow, or for those that Friday. So that's what we have for you on a global level. The next segment, we're going to go deeper into the U.S. and what is happening on that front.